On October 31st, 2025, the Federal Reserve executed a $29.4 billion overnight repo operation through its standing repo facility. That was the largest single-day liquidity injection since the early 2000s dot-com era. There was no press release, no emergency announcement, no explanation beyond the routine operational language that the New York Fed uses when it adds reserves to the banking system through standard repurchase agreement transactions. $29.4 billion injected into the overnight funding market on a single day, quietly, while most Americans were focused on something else entirely. 6 weeks later, on December 2nd, 2025, another injection. This one, $13.5 billion. Again, no press release. Again, the routine operational framing. Unnamed money market desk professionals described it in terms that were not routine at all. One anonymous market participant with direct knowledge of the operation told analysts covering the event that this was not normal December noise. Someone needed cash badly and needed it yesterday. And on December 10th, 2025, the Federal Reserve made an announcement that received almost no mainstream coverage, but that every professional who manages money in the overnight funding markets read with intense attention. Effective December 11th, 2025, the New York Fed's standing repo facility would no longer have an aggregate operational limit. The cap on how much the banking system could draw from the Fed's overnight lending window was removed entirely, full allotment format. Up to $40 billion per institution, per security type, per operation. Twice daily, no ceiling. The Fed removed the ceiling on emergency overnight lending to banks in December of 2025. And on April 27, 2026, the Fed is watching the Monday morning repo market with a specific intensity that the financial media is not adequately describing to the people whose savings, pensions, and retirement accounts depend on the system that market funds every single business day. By the end of this video, you're going to understand exactly what the repo market is and why it is the specific piece of financial infrastructure that makes everything else in the banking system function on a day-to-day basis. Why the transition from abundant reserves to ample reserves that the Federal Reserve completed with quantitative tightening represents the most significant change to the structural liquidity of the American banking system since 2008, and why that transition has left the system operating much closer to the edge of a reserve scarcity event than most people understand. What the specific historical precedent of September 2019 tells us about what happens when the repo market experiences a scarcity event, and why that episode is the specific ghost that everyone in the Fed's open market trading desk is living with every time they open Monday morning. What Jerome Powell's grand jury subpoena, Kevin Warsh's nomination as his potential successor, and the specific political pressure on Federal Reserve independence mean for the institution's ability to respond to a funding market stress event in the current environment. And what three outcomes the current liquidity configuration is navigating between, only one of which does not involve a Fed intervention that markets will interpret as the restart of quantitative easing. Because the liquidity squeeze is not a future risk sitting in a scenario document. It is the current operating condition of a financial system that drained $2.4 trillion in reserves over 3 years of quantitative tightening, ended that tightening in December 2025 when the system reached the edge of what the Fed's own researchers describe as ample reserves, and is now operating in a reserve environment where the range between adequate and scarce is measured in hundreds of billions of dollars rather than trillions, in a macro environment where the forces consuming those reserves are running simultaneously and in the same direction. Let us start with the mechanism, because the repo market is the specific piece of financial plumbing that almost nobody understands until the moment it stops working. And the moment it stops working is the moment that understanding becomes urgently necessary. Every business day, banks, broker-dealers, money market funds, hedge funds, and other financial institutions need to manage their cash positions. Some have more cash than they need overnight, some have less. The repo market is the mechanism that transfers cash between those with too much and those with too little, using government securities as collateral. A repurchase agreement, a repo, is a transaction where the cash-needing party sells a security to the cash-having party and simultaneously agrees to buy it back at a specified price the following day. The difference between the sale price and the repurchase price is the overnight interest rate, called the repo rate. The repo market processes trillions of dollars of these overnight transactions every single business day. The tri-party repo market, where JP Morgan Chase and Bank of New York Mellon serve as the clearing banks that handle the collateral management, processes approximately $4 trillion per day. The bilateral repo market, where institutions deal directly with each other, processes additional trillions beyond that. The repo market is not a peripheral corner of the financial system. It is the circulatory system of the financial system. Every major financial institution in America depends on the repo market to fund its operations on a daily basis. The investment banks, the broker-dealers, the money market funds, the hedge funds, All of them depend on repo market access for the liquidity that keeps them operational between the time they buy an asset and the time they sell it. The Federal Reserve participates in the repo market through two specific mechanisms. The standing repo facility allows primary dealers and eligible depository institutions to borrow cash from the Fed overnight by pledging Treasury securities, agency securities, or mortgage-backed securities as collateral. The Fed buys the collateral, provides cash, and sells the collateral back the next morning. This is the facility whose aggregate limit was removed on December 11, 2025. The reverse repo facility runs in the opposite direction, allowing institutions to lend cash to the Fed overnight in exchange for Treasury collateral. This facility was the mechanism through which the Fed absorbed the enormous excess liquidity that built up during the pandemic-era quantitative easing, reaching approximately $2.5 trillion in daily usage at its peak in 2022 and 2023. The relationship between these two facilities and the level of bank reserves tells you everything about where the financial system sits in the liquidity cycle at any given moment. When bank reserves are abundant, when the system is flush with the cash that the Fed created through quantitative easing, institutions park excess cash in the Fed's reverse repo facility rather than leaving it in the banking system where it earns less. The high reverse repo usage of 2022 and 2023 was the signal of a system swimming in liquidity. When bank reserves decline through quantitative tightening, when the Fed is removing the liquidity it created, the reverse repo facility drains as institutions need their cash back. The reverse repo facility, which peaked at $2.5 trillion in 2022, has now drained to approximately $200 billion or less. The excess liquidity that was parked there is gone. It has been absorbed into the banking system to replace the reserves that quantitative tightening removed. The transition from abundant to ample reserves is the specific change whose significance the Federal Reserve's own researchers have been trying to communicate to a financial community that tends to focus on interest rates and ignores the balance sheet until the balance sheet becomes a problem. The Federal Reserve's balance sheet shrank from $8.9 trillion at its peak in 2022 to $6.5 trillion at the end of quantitative tightening in December 2025. That $2.4 trillion reduction in the balance sheet is a $2.4 trillion reduction in the bank reserves that fund the daily operations of the entire financial system. The system moved from abundant reserves, so much cash, that the overnight rate was pinned at the Fed's floor regardless of market conditions, to ample reserves, enough cash to keep rates stable under normal conditions, but not enough to absorb significant shocks without Federal Reserve intervention. The specific question that every Fed researcher, every money market professional, and every bank treasury manager is asking on every Monday morning is this: are the reserves still ample, or have we crossed the threshold into scarce? The answer is not a clean binary, and the uncertainty about where the threshold sits is one of the most consequential uncertainties in the entire American financial system. The Federal Reserve Bank of New York uses 8 to 10% of GDP as its indicator of ample reserves. 8 to 10% of current U.S. GDP, which is approximately $29 trillion, is $2.3 to $2.9 trillion. The Cleveland Federal Reserve's research published in April 2025 found that estimates of the scarcity threshold range from as low as 7% of GDP, approximately $2 trillion, to as high as 13%, approximately $3.8 trillion. Bank reserves in late October 2025, when the Fed executed the $29.4 billion emergency repo, had declined to $2.8 trillion. That placed reserves at the bottom of the New York Fed's ample range and within the lower bound of the Cleveland Fed's broader range of uncertainty. The $29.4 billion October 31st repo operation was the system signaling that it was testing the lower boundary of ample reserves. Banks were running out of the excess cushion that quantitative easing had provided, and were reaching for Fed liquidity because the private repo market was not providing it at rates below the Fed's standing repo facility rate. The Fed's response, the largest single-day repo operation since the dot-com era, was the correct response. It was the exact function the standing repo facility was designed to perform: provide liquidity when the private market cannot. And the December 10th removal of the aggregate cap, converting the facility to full allotment format at $40 billion per institution per security type, was the Fed's anticipatory response to the expectation that reserve scarcity events would become more frequent, and that a hard cap on how much it could provide would be an operational constraint in a stress scenario. Full allotment is the most important phrase in the December 10th announcement, and the one that received the least coverage. Full allotment means the Fed will provide as much overnight liquidity as the banking system demands at the stated rate without limit. It is the Fed saying, we will not let the repo market seize for want of available Fed liquidity. The cap is gone. Whatever the system needs at the SRP rate, the system can get. The removal of the cap is the Fed's preemptive acknowledgement that the reserve environment has changed fundamentally and that the tools that were adequate when reserves were abundant are not adequate when reserves are ample. Now let us bring in the September 2019 precedent because it is the specific historical event that every Fed official who was in their role in 2019 carries as the institutional memory that shapes Monday morning vigilance in April 2026. In September 2019, the overnight repo rate spiked from approximately 2% to as high as 10% in a single session. 10%. The overnight borrowing rate in the most liquid short-term market in the world more than quadrupled in hours. The cause was a simultaneous convergence of three reserve-draining events. Corporate tax payments due on September 16th required companies to move cash from bank accounts to the Treasury's account at the Fed, which drained bank reserves. Treasury settlement of a large bond auction required dealers to pay for newly purchased treasuries, which also drained bank reserves. And the end-of-quarter reporting period created the usual institutional incentive for banks to window dress their balance sheets by temporarily reducing repo lending. Three events, each manageable alone, converged on the same day. The Fed responded by conducting emergency overnight repo operations of $53.2 billion on September 17th, the largest since the financial crisis. It extended operations to 2-week term repos and then to more permanent balance sheet operations, as it became clear that the reserve scarcity was structural rather than transient. The September 2019 repo crisis exposed the specific vulnerability of an ample reserve system operating close to the scarcity threshold. A simultaneous demand for reserves that is larger than the available supply forces the overnight rate above the Fed's target corridor, and the Fed must intervene to prevent the rate from escaping the corridor entirely. In 2019, the intervention worked. The rate spike was arrested. The system stabilized. But the September 2019 episode established a permanent institutional wariness about operating close to the scarcity threshold that has shaped every subsequent Fed balance sheet decision. The Fed ended its first round of quantitative tightening in September 2019 specifically because the repo crisis demonstrated that reserves had declined too far. It then grew the balance sheet again, and then grew it massively during the pandemic, and then conducted the most aggressive quantitative tightening in Fed history starting in June 2022, and then ended that tightening in December 2025, when the October 31st repo spike indicated that the system was again approaching the operational limit. The specific parallel between September 2019 and April 2026 is not that the crisis is already happening. It is that the structural conditions that produced the 2019 crisis are present in a more complex and more difficult to manage form. In 2019, the reserve scarcity was the product of a single policy trajectory, quantitative tightening, interacting with predictable seasonal factors. The Fed identified the problem, intervened, and resolved it. In 2026, the reserve pressure is coming from multiple directions simultaneously that the Fed does not fully control. The first pressure is the Treasury General Account. The U.S. Treasury keeps its operating cash in an account at the Federal Reserve called the Treasury General Account. When the Treasury's balance in the TGA is high, reserves in the banking system are lower because the cash sits in the government's account rather than in the banking system. When the Treasury spends money, paying contractors, sending benefit payments, servicing the national debt, cash moves from the TGA to the banking system and reserves rise. The TGA balance fluctuates with the Treasury's borrowing and spending cycle. When the Treasury needs to rebuild its TGA balance after reaching the debt ceiling, which it has done repeatedly in recent cycles through extraordinary measures and then large bond issuances, the bond issuance drains reserves from the banking system at a scale that can be significant relative to the total reserve base. The Congressional Research Service analysis published in 2026 identified this dynamic explicitly. The Treasury needs to issue massive amounts of debt to fund government operations, over $1.5 trillion in net new issuance for fiscal 2025, and a similar or larger amount for fiscal 2026. This requires building up cash balances in the TGA, which drains bank reserves. With the national debt at $39 trillion and growing faster than the economy, the pace of Treasury issuance is not declining. It is accelerating. And each dollar of Treasury bond sold in the primary market that is not absorbed by the Federal Reserve's balance sheet, but instead purchased by private sector participants, banks, primary dealers, money market funds, represents a transfer of reserves out of the banking system and into Treasury's account. The second pressure is the foreign central bank Treasury selling that has been running since February 25, 2026. As documented in previous scripts in this series, foreign central banks have sold over $90 billion in U.S. Treasuries, held in custody at the New York Fed, in just 5 weeks since the Iran war began. Turkey alone offloaded $22 billion in foreign government securities. The CEPR's analysis documented what it called the reverse conundrum. The Fed cut short-term rates, but long-term rates rose because the foreign official demand that normally absorbs Treasury supply collapsed simultaneously. The dealer banks absorbed the surplus Treasury supply that foreign officials were selling, with dealer net Treasury holdings reaching all-time highs per the CEPR's research. But dealer inventory absorption is not costless in reserve terms. Dealers fund their Treasury inventory in the repo market. When dealers hold more Treasuries, they need more repo financing. More repo financing demands more reserves. At the same time that foreign official Treasury selling is creating supply that dealers must absorb, the reserve base that dealers use to fund that absorption is under pressure from quantitative tightening's legacy and Treasury issuance demands. The third pressure is the specific condition that has no equivalent in the September 2019 crisis. The Iran war and its economic consequences are creating simultaneous reserve-consuming pressures through three channels. Oil importing nations are selling dollar assets to fund dollar-denominated oil purchases as the Strait of Hormuz blockade drives energy prices higher. That selling reduces foreign central bank dollar reserve holdings. American banks face increased cybersecurity costs, enhanced monitoring requirements, and potential deposit outflows from the specific Iranian targeting threat that is affecting their liquidity management calculations. And the general geopolitical uncertainty premium is elevating demand for short-term safe assets, including the Treasury bills and agency securities that serve as repo collateral, creating the specific dynamic where high collateral demand is interacting with the reserve constraint to tighten funding conditions in the overnight market. Now let us come to the specific person whose decisions about the Federal Reserve's response to this environment matter most, and whose situation in April 2026 adds a dimension of institutional uncertainty that the September 2019 crisis did not carry. Jerome Powell received a grand jury subpoena in April 2026 related to his congressional testimony. That specific fact, the sitting chairman of the Federal Reserve receiving a grand jury subpoena, is the most significant threat to Federal Reserve institutional independence since Richard Nixon fired Fed Chairman Arthur Burns in the political pressure campaigns of the early 1970s, not because the subpoena guarantees any particular legal outcome, but because the specific uncertainty it creates about whether Powell will remain in his role, under what legal constraints his decision-making operates, and what the institutional posture of the Federal Reserve will be during the period of maximum economic stress that the Iran war and the macro environment are creating. That uncertainty is itself a risk factor for the repo market. The repo market functions through confidence. Counterparties lend overnight cash to banks and dealers because they are confident the collateral is good, the system is stable, and the central bank is available as a backstop. The specific backstop capacity of the Federal Reserve depends on its operational independence, its ability to make emergency decisions without political approval, and the institutional credibility that makes its interventions effective. In September 2019, when the Fed executed $53 billion in emergency repos, the market's immediate response was stabilization because the market believed the Fed would do whatever was necessary to prevent the rate from escaping its corridor. That belief was the product of decades of institutional credibility, whose maintenance requires consistent, politically independent decision-making. Kevin Warsh, who has been nominated as the next Federal Reserve Chair, has publicly and consistently argued against the Fed's large balance sheet. He dissented from QE2 in 2011 and has maintained that position through his nomination process. A Fed chair who believes the balance sheet is too large and should be further reduced would face the specific institutional tension of managing an ample to scarce reserve transition while being philosophically opposed to the balance sheet growth that the only available resolution of that transition requires. The specific policy combination of Warsh's balance sheet philosophy, the reserve environment that December 2025's QTN left behind, the Treasury issuance demands of a $39 trillion national debt, and the foreign official Treasury selling that is consuming dealer balance sheet capacity is the combination that the Fed's open market trading desk is managing on every Monday morning. Now let us examine the three specific outcomes that the current configuration of reserve adequacy, Treasury supply, foreign official selling, and institutional uncertainty is navigating, because the outcomes are specific and the signals that distinguish them are identifiable. The first outcome is the managed sufficiency. This is the outcome where the reserve base remains adequate through the combination of the full allotment standing repo facility, providing the overnight liquidity backstop the system needs, the Treasury's debt issuance being absorbed without creating a concentrated reserve draining event comparable to September 17, 2019, the foreign official Treasury selling finding new private sector buyers without requiring the Fed to resume purchases, and the Fed's twice daily repo operations, providing just enough routine support to keep the overnight rate within the target corridor. In this outcome, the Monday morning repo market is active but not stressed. The Fed's operations are visible but not dramatic. The system is operating in the specific zone that the New York Fed described as ample, close enough to the boundary to require vigilance, far enough from the boundary to avoid crisis. The managed sufficiency outcome is consistent with what the Fed's December 2025 policy framework was designed to achieve. QT ended before reserves became truly scarce. The full allotment SRP provides the unlimited backstop that prevents a September 2019 repeat. The twice-daily operations allow the Fed to respond to intraday reserve stress at a frequency that the once-daily operations of September 2019 could not match. The January 2026 reserve management purchases, where the Fed bought approximately $40 billion per month in T-bills through mid-April 2026 tax day, provided a temporary reserve injection that offset some of the Treasury issuance drain. The managed sufficiency outcome is the outcome that the Fed's current policy framework was designed to produce, and that the most optimistic reading of current reserve data suggests is achievable. The second outcome is the repo spike and response. This is the outcome where a specific convergence of reserve draining events, a large Treasury settlement, a corporate tax payment date, an end-of-quarter reporting period, a foreign central bank liquidation of a large Treasury position, or an unexpected cybersecurity event at a major repo participant, occurs simultaneously and produces the same rate spike that September 17, 2019 produced. The difference between 2019 and 2026 is that the Fed's response mechanism is better positioned. The full allotment SRP means the Fed can provide unlimited overnight liquidity at the SRP rate, rather than being constrained by the $40 billion per operation caps that existed before December 11, 2025. The twice-daily operations mean the response can arrive within hours of the spike, rather than the following morning. The specific problem with the repo spike and response outcome is not whether the Fed can respond. It is what the market interprets the response as. In September 2019, the Fed's emergency repo operations were eventually accompanied by growth in the Fed's balance sheet as the situation required. The market interpreted that balance sheet growth as the restart of quantitative easing. The specific policy that had been associated with asset price inflation, dollar devaluation, and risk on positioning since 2009. The stock market rallied. Crypto rallied. Every risk asset that benefits from dollar liquidity expansion rallied. And then the Fed spent months arguing that what it was doing was not quantitative easing, but rather technical reserve management, an argument that lost credibility as the balance sheet continued to grow. In 2026, the same argument would be even harder to make convincingly. The Fed has already ended one round of quantitative tightening in December 2025. It is already conducting reserve management purchases of $40 billion per month in T-bills. Warsh's nomination as the next chair, with his publicly stated philosophy of balance sheet reduction, creates the specific political dimension where any Fed response to a Monday morning repo spike that involves meaningful balance sheet expansion will be interpreted through the lens of Powell versus Warsh and the Federal Reserve's independence from the political pressure that produced the grand jury subpoena. The repo spike and response outcome is not just a monetary plumbing event. In 2026, it is a political event, an institutional credibility event, and a market signal event simultaneously. The third outcome is the reserve scarcity event. This is the outcome where the managed sufficiency framework fails to hold, and the repo spike and response mechanism is not fast enough or large enough to prevent the overnight rate from escaping the Fed's target corridor in a way that cascades through the funding market. The specific cascade looks like this. The overnight repo rate rises above the SRP rate, signaling that demand for reserves exceeds the available supply even with the Fed's facility open. Banks whose overnight funding positions are more expensive than anticipated reduce their Treasury inventory to free up balance sheet capacity, selling Treasuries into a market where foreign official selling is already creating supply. Treasury yields rise as the additional supply hits. Rising Treasury yields increase the unrealized losses on bank investment portfolios, which are already at $306 billion. A bank with large unrealized losses and a suddenly more expensive overnight funding position faces the specific combination of balance sheet stress that Silicon Valley Bank faced in March 2023. The repo market stress does not stay in the repo market. It transmits through the chain of assets and institutions that the repo market funds. The reserve scarcity event outcome is the outcome that the full allotment SRP was specifically designed to prevent. The cap removal on December 11th, 2025 was the institutional acknowledgement that the cap itself was a vulnerability, that a hard limit on Fed overnight lending could become a binding constraint in a stress scenario. The unlimited backstop is the policy response to that vulnerability. But unlimited backstop availability is not the same as unlimited backstop credibility. The credibility of the unlimited backstop depends on whether the market believes the Fed will use it freely at whatever scale the situation requires, without political interference, without institutional hesitation, and without the specific complication of a Fed chair facing a grand jury subpoena and a successor nominee who is philosophically opposed to balance sheet expansion. The reserve scarcity event is not the base case. It is the tail risk whose probability has been elevated by the specific combination of factors that have assembled in April 2026. And elevated tail risks in funding markets deserve specific attention precisely because funding market events compound faster than almost any other category of financial stress. The September 17, 2019 rate spike went from 2% to 10% in hours. Silicon Valley Bank went from solvent to failed in one business day. The speed of funding market stress events is their specific defining characteristic, and the reason the Fed watches the Monday morning repo market with attention that it does not give to any other single data point. Now let us examine the specific reason that Monday morning is the specific time of week that deserves the most vigilance, because the structure of the financial week creates a predictable vulnerability pattern that every repo market participant, every Fed operations desk professional, and every bank treasury manager understands, but that most observers outside those circles do not. The repo market does not close over the weekend in the way that equity markets close, but its operational rhythm is profoundly shaped by the weekend. Friday afternoon is when the bulk of the week's repo positions mature or are rolled. Institutions that need overnight funding on Friday enter the Friday morning repo market and borrow cash through close of business Friday. Those repos mature on Monday morning. The institutions must either repay the cash and return to the repo market to borrow again for Monday night, or roll the repo, enter a new transaction at Monday's prevailing rate for the new overnight period. The Monday morning repo market is the specific moment when the accumulated funding positions of the entire financial system are simultaneously repricing and rolling at the opening of the first trading session of the week, absorbing whatever weekend geopolitical, economic, or policy developments have occurred since Friday's close. In a reserve-abundant system, the Monday morning roll is routine. There are so many reserves in the system that every institution can fund itself at rates very close to the Fed's floor, regardless of how much demand is present simultaneously. In an ample reserve system operating near the lower bound of adequacy, the Monday morning roll is the specific stress test of whether the reserve base is sufficient to handle simultaneous demand. If the answer is yes, Monday opens normally. If the answer is no, the rate spikes, the Fed intervenes, and every market participant updates their mental model of how close to the edge the system is operating. The specific Monday mornings that draw the most Fed attention are the ones that follow the reserve draining calendar events that the 2019 experience documented. The mid-April tax day is one of those events. Tax payments move cash from bank accounts to the Treasury's account, draining bank reserves simultaneously across the entire economy. The reserve management purchases of $40 billion per month that the Fed was conducting through mid-April 2026 were specifically calibrated to offset the reserve drain of tax day. The Wolf Street analysis published March 5, 2026, confirmed that after tax day, the reserve management purchases would be significantly reduced. The period immediately after the tax day reserve drain and the reduction in reserve management purchases is the period when the reserve base is most vulnerable to additional stress, when the buffer that the RMPs had been providing is no longer being replenished and the system is running on whatever reserve cushion survived the tax day drain. The week of April 27, 2026 is the week after tax day. It is the first week after the reserve management purchases were significantly reduced. It is a week when the Islamabad ceasefire process is at its most advanced and most uncertain phase simultaneously. It is a week when Jerome Powell is navigating a grand jury subpoena, and Kevin Warsh's nomination as his potential successor is creating institutional uncertainty about the Fed's policy direction. It is a week when dealer banks are holding all-time high Treasury inventories that they are financing in the repo market. At the same time, foreign official demand for those treasuries is at its lowest in over a decade. And it is a week when bank reserves, while not yet at the scarcity threshold by the New York Fed's 8 to 10% of GDP measure, are operating in the range where the Cleveland Fed's research found that estimates of the scarcity threshold are so uncertain that some models would already categorize the current level as scarce. All of that is why the Fed is watching the Monday morning repo market with specific intensity on April 27, 2026. Not because a crisis is predetermined, not because the system is broken, but because the specific configuration of reserve adequacy, Treasury supply, foreign official selling, dealer inventory positioning, post-tax day reserve dynamics, and institutional uncertainty that exists in the last week of April 2026 is the configuration in which the Fed's own history, specifically September 17, 2019, tells it that the Monday morning opening can produce surprises that move faster than any institutional response can run. The historical pattern that makes this moment specifically important is the pattern that every repo crisis in American history has followed. The repo market does not fail gradually, it fails suddenly. The September 2019 spike from 2% to 10% happened in hours, not days. The March 2020 repo market freeze, when the pandemic hit and every participant simultaneously needed liquidity, happened within a week. The March 2023 regional banking crisis, which was fundamentally a repo and funding market event expressing itself through deposit outflows, happened to Silicon Valley Bank in one business day. The common thread is speed. The funding market, when it becomes stressed, moves at the speed of the communication networks that participants use to execute transactions, which is to say, at the speed of a Bloomberg terminal message or a phone call between treasury desks. The Fed's tools, even with the full allotment SRP and the twice daily operation cadence, operate at institutional speed. The Fed's open market trading desk must observe the rate deviation, determine its scale, decide on the operational response, execute through its counterparties, and wait for the reserve injection to reach the system. That process takes hours at minimum. In a repo spike that goes from 2% to 10% in the first 2 hours of the Monday morning session, several hours of institutional process time is not a trivial gap. It is the window during which the funding market stress can transmit to dealer balance sheets, treasury yields, equity futures, and the specific risk-on risk-off signal that Bitcoin has been broadcasting to the equity market every weekend. Here's what all this means for the person who is not a repo market professional, but who has a savings account, a pension, a 401k, or any other financial claim on the system that the repo market funds. The repo market is not something you interact with directly. You have never placed a repurchase agreement. You will never receive a margin call from a repo counterparty. Your financial life is not expressed through overnight funding transactions denominated in T-bills at rates between 4 and 5%, but every financial institution that holds your savings, manages your pension assets, custodies your brokerage account, and processes your direct deposit paycheck depends on the repo market for its daily operational liquidity. The bank that holds your deposits needs repo market access to fund its overnight balance sheet position. The money market fund, where institutional investors have parked $7.82 trillion, invests in the repo market as its primary vehicle for deploying cash. The broker-dealer that holds your 401k assets in custody depends on repo market access for its securities financing operations. The repo market is the bloodstream of the financial system, and the system's health depends on the bloodstream flowing smoothly. When the bloodstream tightens, when the reserve base approaches scarcity, when the Monday morning roll becomes expensive, when the Fed's backstop is tested, every institution downstream of the funding market feels the pressure. It is not felt the way a stock market decline is felt in a number that changes on a screen that you can see. It is felt in the credit conditions that banks offer, in the net interest margins that determine bank profitability and therefore bank capacity to lend, in the treasury yields that determine the discount rate for every asset in the financial system, and in the specific mechanism by which higher overnight funding costs transmit through the yield curve to the mortgage rates, car loan rates, and credit card rates that touch ordinary financial life directly. The liquidity squeeze is not a crisis in progress. The full allotment SRP is functioning. The Fed is watching. The system is ample. But the specific meaning of ample reserves, as the Cleveland Fed's research established, is that the system has enough reserves to function under normal conditions, but not enough to absorb significant shocks without Fed intervention. In April 2026, the conditions are not fully normal. The post-tax day reserve drain, the foreign official treasury selling, the dealer balance sheet saturation, the geopolitical uncertainty premium, and the institutional uncertainty around Federal Reserve leadership are all simultaneously applying pressure in the same direction. The Monday morning repo market is where that pressure becomes numerically visible in the form of a rate. And the Fed is watching that number with the institutional memory of September 17, 2019, when the number went from 2% to 10% in the time it took for most Americans to finish their Monday morning coffee. 3 outcomes. Managed sufficiency is the base case and the intended outcome of December 2025's policy framework. Repo spike and response is the scenario that the full allotment facility was built to arrest before it becomes the third outcome. Reserve scarcity event is the tail risk whose probability is not negligible in the specific environment of the week of April 27, 2026. The Fed is watching. The repo market is open. The Monday morning session begins in hours, and the rate that prints at 9 a.m. tells you everything about which of the 3 outcomes April 27th delivers. $2.4 trillion drained in 3 years of quantitative tightening. The reserve base reduced from abundant to ample. The ceiling on overnight Fed lending removed in December 2025. The largest single-day repo injection since the dot-com era, executed on Halloween 2025. The September 2019 ghost still in the room. And the Monday morning opening of the repo market, watched by the Fed's open market trading desk, with the specific intensity of an institution that knows exactly what it does not know, which is whether the reserves that were ample on Friday afternoon will still be ample when the business week begins,